We've been watching semis, which have done, quite well of late, to say the least. I mean, some had rallied 20, 30, 40%. The question is, have they moved too much? And is a reversion coming? Let's bring in Jonathan Krinsky, BTIG Chief Market Technician, as a new note out. It's good to see you. I hope you had a good Thanksgiving. That is the crux of your note here, is that you call the move in semis extreme, right? And you say it does set up reversion opportunities. I'm wondering what that means for the overall market as well.
Yeah, so let's start. Thanks, Scott. Good to see you. Let's start with the overall market. I think there's a bit of a assumption here that December is going to just be smooth sailing, year-end rally. And there's a lot of truth behind that. If we look at December back to 1930, the average return is about 1.44%. When the S&P is up through November, the average December returns over 2%. But when you look at when the S&P is down 15% or more through the end of November, as it could well be this year, we have another couple days, the average December return is actually negative 2.16%. So I think the story there is that, December in bear markets or in down markets is a much different story than the average December. And I think it could surprise to the downside. So we would not be, looking for that seasonal year-end rally from here to the end of the year. Now, as it relates to the semiconductor index, or semis broadly, they just had a 27% rally over 25 days. That's pretty extreme. We've only seen that a handful of times in the last 25 years. Now, the difficulty, if you're just using that specific stat, we see it both in the midst of bear markets. We saw it in early 2001. We saw it in January 2009 before the final bottom. And then, of course, we do see it at the start of new bull markets, like we saw in March of 2009, April 2020. So like a lot of those stats, you don't want to just use them in isolation. You want to recognize that we've had this extreme move, but by our work, the benefit of the doubt is still to the downside. We're still below declining 200-day moving averages. There's still a lot of overhead supply. If you think about the SMH ETF, pretty much the entirety of the 2021 trading range is above where we are now. So that's a lot of overhead supply. So we just think this 27% rally into the following 200-day represents an opportunity to reduce risk in semis, not to be pressing them here.
Okay. I appreciate the perspective. Jonathan, thank you. That's Jonathan Krinsky, BTIG.